So let's begin with the big issue. Markets pricing a rate cut and a soft landing.
The possibility of a cut.
Of a rate cut.
Rate cuts from the Fed.
The odds of a rate cut by the end of the year
Much later in the year
is increasing quite rapidly.
The Federal Reserve is probably nearer a rate cut than a rate hike.
We haven't seen any sign that that's needed yet.
The Federal Reserve may have actually engineered what could be a pretty soft landing.
A soft landing for the global economy.
I think they're in a good spot.
it will really depend on how the growth data comes out.
You will have a cut if the trade talks really break down.
I have zero doubt in my mind in that environment the Fed is cutting rates.
Joining me around the table to discuss, George Rusnak of Wells Fargo Investment Institute, Alessio de Longis of OppenheimerFunds and Tony Dwyer of Canaccord Genuity. Tony, can they engineer that soft landing?
The bond market's engineering the soft landing. The Fed's not engineering anything. The bond market, I think it's extraordinary. The rates have come down 100 basis points. Mortgage rates are down 100 basis points, John. And that is stimulative to the economic activity. They're already way ahead of what the Fed's going to do. The Fed could change the variable debt structure, but if you're somebody looking to get a home and you couldn't do it because interest rates were too high at the end of last year, around my area, all the houses that were for sale are now under contract because people are, looking at these lower rates and it's stimulating activity.
George?
Couldn't agree more. You're seeing it actually now reflecting the housing market numbers that we saw this morning. So from our perspective, looking at GDP potentially going down from 3% to 2% is engineering a soft landing. And so 2% is not a bad growth rate from our perspective and doesn't really call for the Fed to kind of ease more.
We've seen treasuries and equities rally in tandem many, many times before through this cycle. There is a difference this time, though, Alessio, because treasury yields out to a 7-year maturity have been trading through the lower bound of the Fed funds rate. This is a market that's looking for a rate cut. Now, some people ask, what is the bond market telling me? As if the bond investors have a secret the equity market doesn't know about, which is why I think the rate cut story is so interesting. It's not just the rate cut we're priced for. It's the belief that that stimulatory monetary policy can avoid the negative economic situation that would be detrimental to risk assets. It is the elusive soft landing.
Yeah, the entire bond market rally this year, the drop in yields is the primary explanatory factor of the stock rally this year, because otherwise the cash flow situation, the earnings situation has deteriorated meaningfully. Those are the two main drivers of stocks. Now, it's true that we have seen the bond market already engineering, helping the soft landing. At the second stage of this, to be self-sustained, we need, in my opinion, some re-steepening of the yield curve. In order to create sustainable credit conditions over the long term. At the moment, we're not seeing any tightening in lending standards, but obviously it's the persistency of a flat yield curve for a prolonged period of time that it will eventually disincentivize credit creation.
So for me, what's interesting at the moment, Tony, as always, we are obsessed with the shark closest to the boat. The shark closest to the boat is the trade story. The storm clouds are gathering. The data's weaker. What was interesting about the session yesterday is that we had soft data from China, soft data from the United States. We traded on it for the best part of 5 minutes, then saw a trade headline, and we're off to the races again. Do you think we are ignoring some of the softening up of the economic data worldwide?
That's the whole bull story. Since January, people keep thinking like the bull story is good economic growth. The whole bull story is that there's not good economic growth, and it allows the Fed data and room to actually cut rates to re-steepen the yield curve, which incents lending. The funniest part of this whole thing is that this data is going to get weaker, John.
Yeah.
It's a lagged effect of higher interest rates. In the meantime, Germany showed a little bit of a turn. And if you look at the OECD leading indicators and the breadth of them turning positive, it's inflected from a historic low. Now is not the time to bet on slower growth globally. It's time to bet on slower growth domestically with a turn globally so that you get this kind of 2%-ish growth rate that allows for corporate profits to expand in the market multiple.
George, your thoughts?
Yeah, from our perspective, I agree that things have slowed down and are slowing down. We've actually lowered GDP forecasts. A lot of that, though, we think is going to be factored into the marketplace. And just wonder if the bond market is getting a little bit out over its skis, pricing in a couple rate hikes. Yeah. Whereas the reality is, if you look at sort of their metrics, the idea of full employment, price stability, everything is fine from that perspective. It's this global economic uncertainty that's causing it. And I would argue we're actually not in that bad of shape. If you look at the stock markets this year, right, whether you look at the NASDAQ or the S&P or the Dow, they're up anywhere from 10 to 18%. Even domestic developed markets are up 10%, and emerging markets are up 7 or 8. That's not a bad return.
Tony, you want to jump in?
John, think about this. Okay, let's forget about the stock market in 1995. In 1994, inflation was collapsing, and Alan Greenspan was worried about tight labor markets and inflationary pressures and almost drove us into a recession by nearly inverting the yield curve. That is kind of today. There's no inflationary pressures. The 5-year inflation break-evens are coming down hard. Core inflation is actually turned down from below 2% on the core PCE. So if you've tightened like we did last year and nearly inverted the curve because you're worried about inflation, somebody better tell every single indicator that exists, because they're all turning down.
So many economists say the Fed's not going to cut rates unless current conditions deteriorate markedly. You don't think that's the case?
I've been insanely calling for a rate cut since January, when it became apparent if you made a policy mistake and a communication mistake in December, we have reversed the communication mistake. We have not reversed the policy mistake. It's not an easing, it's reversing a policy mistake.